All right, let's get right into it. We're talking about what might just be one of the biggest changes to money in our lifetime: central bank digital currencies, or CBDCs. Now, this isn't just some new payment app. We're talking about a fundamental reinvention of the money that a country's central bank issues. I want you to really think about this for a second. I'm not talking about the money that's already in your bank account. That's basically just a digital record. I mean the actual physical cash, the dollars or euros or yen that you might have in your wallet. What if that became a direct digital claim on the central bank itself? See, right now, the money in your PayPal is a claim on a private company. A CBDC would be like having a direct digital account with the Federal Reserve. It's a whole different ballgame. So why this sudden global rush? I mean, it's not just some tech fad or about keeping up with the times. It's actually a mix of offense and defense. It's a chance to build a better, more efficient financial system, but it's also a strategic move to counter the rise of private digital currencies. And get this, over 90% of the world's central banks are already working on this. This is happening.
And when you look at the motivations here, you can see it's a really wide range. For big, developed economies, it might be all about efficiency, cutting the insane costs of printing, securing, and moving all that physical cash around. But for developing nations, it's a potential game changer for financial inclusion, a way to bring millions of people into the formal economy. And for pretty much everyone, it's about sovereignty, making sure that central banks, not some giant tech company, stay in control of a nation's money.
It all sounds pretty good in theory, right? But, and there's always a but with ideas this big, the devil is absolutely in the details. The entire impact of this thing, both the good and the bad, really hinges on the answer to one single, incredibly important question. And this is it. This is the big one. Does this new digital currency just replace the physical cash in our pockets? Or does it start to replace the money we keep in our regular commercial bank accounts? The answer to that question? Well, it changes absolutely everything. That one question basically splits the future of money down two completely different roads, and each path has its own set of game-changing consequences. So on one side, you have what we can call the digital cash swap. Pretty simple, right? It's a one-for-one replacement of paper money with digital money. But on the other side, you've got this bank competitor scenario, and that's where the CBDC becomes a real alternative to a traditional bank deposit. Let's break down what each of these really means. All right, so path one. This one's the straightforward, low-risk option. People just trade in their physical banknotes for a digital version. And since that cash was already outside the commercial banking system to begin with, the banks barely even notice. It's really just a change in format. No big deal. But path two, this is where the ground really starts to shake. If people start thinking, hey, this new CBDC wallet is super safe, maybe I'll move my savings there, and they start pulling their money out of commercial banks, well, that triggers a chain reaction with some potentially serious risks.
So why is that such a big deal? You got to understand, commercial bank deposits or savings aren't just sitting in a vault gathering dust. No way. They are the absolute lifeblood of the lending system. Think of them as this huge, low-cost reservoir of water that banks use to fund mortgages, business loans, and car loans for all of us.
And this table here just lays out the problem perfectly. When that big reservoir of cheap retail deposits starts to drain away, banks have to find water somewhere else. They're forced to turn to more expensive and way less stable sources, like borrowing huge sums from other big financial institutions. That's called wholesale funding. And it's a much riskier, much more expensive way for a bank to do business. Okay, so let's follow that domino effect. What are the real-world risks when the fundamental way our banking system is funded gets turned upside down? Well, the consequences could be pretty severe. We're talking about banks suddenly struggling to meet their safety requirements. We're talking about their profits getting squeezed, which could force them to charge you and me more for a mortgage or a car loan. And maybe the scariest part, it could create the perfect conditions for a bank run to happen at the speed of light, with just a click. And if you want to put a hard number on it, check this out. The IMF's analysis suggests that if CBDCs become really popular and they're not designed carefully, bank lending to the real economy, to businesses and families, could shrink by as much as 8%. That is a major credit crunch that would be felt by everyone. And listen, this idea of a digital bank run isn't some science fiction fantasy. As this quote right from the source paper points out, we've already seen how social media and mobile banking can throw gasoline on a crisis. A CBDC could be like adding rocket fuel to that fire by giving everyone a perfectly safe government-backed escape hatch during a panic. So is this whole thing just a terrible idea? Are CBDCs dead on arrival? Well, no, not at all. The key isn't to just ditch the idea, it's to design them intelligently from the very beginning so we can get all of the cool benefits without the dangerous side effects. And this solution, according to the research, really boils down to two core principles. It's actually pretty clever. First, you put a cap on how much of this digital currency any one person can hold at a time. And second, you make it a really unattractive place to save money by paying zero or maybe even negative interest on it. This gets to the absolute heart of the design philosophy here. The goal is to make the CBDC a fantastic means of payment, but a really lousy store of value. Think of it like this. You want it to be like your debit card, perfect for buying a coffee, but you absolutely do not want it to be like your high-yield savings account, where you'd park your life savings. See, this clever design gently nudges our behavior. It makes the CBDC the perfect tool for our daily shopping, while making sure that that deep pool of savings that fuels our economy, the money for mortgages and for new businesses, stays right where it needs to be, inside the commercial banking system. So at the end of the day, what this all comes down to is a very careful, very deliberate balancing act for policymakers and central bankers all over the world. The central challenge is laid out right here, crystal clear. How do we embrace the incredible potential of this innovation without accidentally wrecking the financial engine that powers our entire modern economy? It is an incredibly fine line to walk. And that leaves us with the final critical question, doesn't it? As we stand right on the edge of this potential monetary revolution, the real test is going to be whether we have the foresight and the wisdom to engineer the future of money without creating a crisis in the present.